Let me tell you 3 quick stories. First, a man who didn't start investing until 42. No inheritance, no lucky break, just a normal salary, and a credit card balance he'd been dragging around for 6 years. By 55, he had $780,000 in index funds. Second, a woman working retail management at 38, living paycheck to paycheck, 0 assets. Today, she's 49 with over $400,000 invested and on track to retire at 57. Now, the third story. A guy in his 30s making 6 figures. Traded individual tech stocks, played options, felt brilliant during the bull market. By 41, he had less invested than the retail manager. His portfolio chart looked like a heart monitor in an emergency room. Up, down, flat, repeat. So here's the uncomfortable question. If you're starting from 0 in 2026, which one are you going to be? Today, I'm going to give you the exact sequence I would follow if I woke up tomorrow with no investments, some debt, a job that pays the bills, and not much else. This isn't theory. This is the framework I've used to build multiple 6 figures invested over the past decade while running my own business, learning from accountants and tax attorneys who understand how money really moves. And here's the twist. 2026 actually gives you a cleaner starting point than the past decade if you ignore the noise. Yes, interest rates aren't 0 anymore. Yes, housing looks absurd. Yes, AI is reshaping the job market. But the math still works. And wealth building only requires math and psychological discipline. The 3 buckets framework. Think of wealth like filling 3 buckets. Bucket 1 has a hole in the bottom. That's debt. Bucket 2, your foundation. That's cash. Bucket 3, your engine. That's investments. Most people try to fill bucket 3 while bucket 1 is leaking. You can't outpour a hole. The order matters more than the assets. Step 1. Destroy the leak. Debt. In 2026, average credit card interest is around 24%. Some store cards push 29%. If you carry $5,000 at 24% and pay minimums, you'll pay nearly $10,000 total. That's a 100% markup on money you already spent. And yet, people ask, should I buy AI stocks? Should I buy crypto? Paying off that card is a guaranteed 24% return. Find me another guaranteed 24% return in public markets. It doesn't exist. But the real cost of debt isn't just interest, it's psychological. Debt installs a scarcity operating system in your brain. When you owe money, you don't negotiate aggressively, you don't take career risks, you don't move cities for opportunity, you don't ask for the raise, because the payment is always due. Debt doesn't just reduce cash flow, it reduces courage. I know someone who had $18,000 across 3 credit cards at 22%. He used the avalanche method. List debts, highest interest to lowest, attack the top aggressively, pay minimums on the rest. He sold his second car, downgraded apartments, canceled subscriptions, treated it like a fire. 12 months later, gone. 6 months after that, he negotiated a promotion worth $14,000 per year. The debt wasn't just costing interest, it was costing confidence. Clear the leak. Only then move forward. Step 2. Build the cash fortress. Once debt is gone, most people jump into investing. This is where plans die, because life happens. The car breaks down, medical bill, family emergency. If your money is invested and the market is down 15%, you have 2 choices. Sell at a loss or don't pay the bill. Either one permanently damages compounding. This is why bucket 2 exists. 3 months of bare bones expenses. Rent, food, utilities, minimum transport. Multiply by 3. Put it in a high-yield savings account or money market earning 4 to 5%. This is not an investment. It's insurance against panic. Let me show you the difference. 2 investors. Market drops 20%. Both lose jobs. Investor A is fully invested. Sells at the bottom to survive. Locks in a loss. Investor B has $12,000 in cash, lives off buffer, leaves portfolio untouched. Recovery happens, portfolio rebounds. Investor A is permanently behind. Investor B is intact. The market rewards those who never have to sell at the wrong time. Cash gives you psychological space. It prevents cortisol-driven decisions. When you have liquidity, you negotiate differently. You think clearly. Without it, you trade with fear. Build the fortress first.
Step 3. Invest boringly and intentionally. Now and only now do we invest. But here's where people derail. They over-diversify tiny portfolios, or they stock pick. The fantasy is finding the next NVIDIA early. The reality? Over 15 years, more than 90% of professional fund managers fail to beat the S&P 500. These are people with Bloomberg terminals and analyst teams. Individual investors underperform by 4 to 5% annually, not because they're stupid, because they trade too much, chase trends, let emotions decide. When you buy the total market, you capture average, historically about 10% annually before inflation. Average in the stock market makes you rich. Exciting investing usually makes you poor. Good investing feels like watching paint dry. If it feels thrilling, you're probably gambling. The core satellite structure. Here's how I'd structure it. 90% of investments, low-cost, broad market index funds, total US and international exposure, automated, untouched. 10% speculative sandbox, tech stock, crypto, whatever scratches the itch. If it goes to zero, you're fine. If it moons, great. You control the lizard brain without letting it run the system. Step 4. The hidden 30% leak, taxes. Most people ignore this and lose decades of compounding. If you invest only in taxable brokerage accounts, you pay capital gains tax, you pay dividend tax, you experience tax drag. The government literally created tax shelters to incentivize retirement saving. Ignoring them is volunteering to lose money. Example, invest $10,000. It grows to $100,000. Taxable account, you pay 15 to 20% capital gains on $90,000. That's up to $18,000 gone. Roth IRA, withdrawal is tax-free. That difference isn't stock picking, it's account location. And if your employer offers a 401k match, that's a 100% instant return. You cannot beat that. Yes, money is locked until 59 and a half. That's the point. It protects you from yourself. The early withdrawal penalty is a behavioral guardrail, and Roth contributions can be accessed early if needed. Here's the waterfall. 1. Contribute to 401k up to employer match. 2. Max Roth IRA, $7,000 under 50. 3. Max HSA if eligible, triple tax advantage. 4. Max remaining 401k. 5. Only then use taxable brokerage. Sequence creates acceleration. Real scenario, Jake. Jake is 38, makes $65,000, $4,000 credit card debt at 21%. Month 1 to 8, he kills debt aggressively. Month 9 to 21, he builds a $9,000 emergency fund, then invests. 4% to 401k to get match. Max Roth IRA. Total annual investment $9,600. Assume 7% real return for 27 years. That grows to roughly $870,000. One 10% raise in year 5, he crosses $1 million. Not fantasy, compound interest uninterrupted. Step 5. Stop playing defense, upgrade income. There's a limit to cutting expenses. There's no ceiling on earning. The latte factor won't make you rich. You cannot budget your way to wealth on $40,000 in 2026. Defense prevents loss. Offense creates wealth. Driving rideshare might net $20 an hour. Stop driving, income stops. Learning a leveraged skill, data analysis, technical sales, coding, project management, that could add $20,000 to $30,000 annually recurring. Raises compound, 401k matches increase, future raises stack.
A 10% salary bump is worth more than endless side hustles. But learning new skills is uncomfortable. Low friction income is easy. High leverage income is hard. Everyone can drive. Not everyone can analyze datasets. Discomfort is the entry fee to leverage. Do a skill audit. What one skill would make you undeniable at work? Spend 1 hour daily learning. In 6 months, ask for the raise or apply higher. Increase the shovel and everything accelerates. The entire playbook in order. If I woke up at 0 in 2026, 1. Eliminate high-interest debt using Avalanche. 2. Build 3 months cash buffer. 3. Use tax-advantaged accounts in waterfall order. 4. Invest 90% in boring index funds, 10% optional speculation. 5. Aggressively upgrade income.
That's it. Not complicated, just psychologically difficult. What about real estate, crypto, alternatives? Once you have 200K or 500K invested, sure, explore. But at 0, they're distractions. Shiny objects delay foundation building. Sequence first, complexity later. The psychology is everything. The industry wants you to believe wealth is complex, secret strategy, special platform, insider edge. Truth? Kill leaks, build buffer, use tax shelters, buy boring funds, increase income. The math is simple. The challenge is not interrupting compounding. You'll feel stupid during market crashes. You'll feel behind when coworkers brag about hot stocks. But patience builds wealth. Intensity does not. 3 takeaways. 1. Debt is a guaranteed negative return. Eliminate it first. 2. Tax-advantaged accounts are as close to free money as you'll find. Use them in order. 3. Income has unlimited upside. Expenses have a floor. Focus accordingly. In 2026, with AI hype, market noise, chaos headlines, the fundamentals haven't changed. Time in the market beats timing the market. Consistency beats intensity. And boring wins. Wealth isn't built by genius. It's built by people who simply don't get in their own way. If you're starting from 0, the math is waiting. The only question is whether you'll follow it.